The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. We've got a jam-packed, fantastic show for you. I'm Steve Sedgwick with Ritika Gupta here at Canary Wharf. And we've also got, of course, Karen and Juliana in the studio. These are your headlines. The UK economic outlook taking centre stage as we take Squawk on the Road here at Canary Wharf. We're going to be speaking to business leaders throughout the morning, including, the CEO of Canary Wharf Group and executives from Barclays, Citi and JP Morgan.
European stocks look set to follow Wall Street into the red as Fed Chair Jerome Powell pushes back on rate cut expectations, saying policymakers face a challenging situation.
Two-sided risks mean that there is no risk-free path. If we ease too aggressively, we could leave the inflation job unfinished. If we maintain restrictive policy too long, the labor market could soften unnecessarily.
And JD Sports half-year results just crossing the wires. We'll talk through the numbers and the outlook with the CEO of JD Sports, Regis Schultz, in just a few minutes.
Look, it's a real privilege to be down here at Canary Wharf, and I'll say it now, they're treating us fantastically here at a centre which I've had questions with the CEO previously about the occupancy, about the appetite for two financial centres as well, and he's got a very robust response for us today as well, because actually things are looking very interesting as well. But are they looking better for the broader UK economy? And I think it is superb that we are down here at the Wharf speaking to all these great business leaders at a time when, to my mind, the trepidation is up to an 8 or 9 on the volume dial, because this budget, which is going to be very, very late as well, is keeping us all on tenterhooks.
Yeah, and you've hit the nail on the head. What I'm really looking forward to, Steve, speaking to these senior execs, is how they view London right now as a financial centre. There is all this talk about a wealth exodus, IPO market in London suffering, wealthy people leaving. How much of that is true, and what can London do to get things back on track? That's what I really want to hear about, particularly as you mentioned, we're in the run-up to the autumn budget. We've got the Labour Party conference next week. I'm sure a lot of this is going to come up. Yeah,
look, and I have a privileged position where I can say what I think on a lot of this stuff without ramifications, and quite frankly, I think you've got a government which is very, very dangerously looking at new sources of income from, dare I say, a lot of these financial organisations, from the growth areas as well, when actually, if leaving them as they are potentially, okay, it may not appeal to their base somewhat in terms of the taxation and the wealth taxes and the banking taxes, but actually these are the areas where we're going to find growth. And if we try and extract too much tax from it as well, I think we are in danger of that wealth and that growth, as you say, going elsewhere. But anyway, we've got a brilliant guest coming up now.
And can't think of a better place to discuss all this than here at Canary Wharf, because as Steve said, being here today, we've seen the evolution of the space that has continued at pace in recent years. In 2019, this area was overwhelmingly dominated by office leases, at 94% in fact, so with retail and residential leases making up the remainder. Now you fast forward to today, and while office leases still make up the majority, the area has seen an increasing number of residential units come to the fore, while retail units have also expanded. Hotels now actually make up 1% of the overall figure, and the diversification is set to continue, with forecasts suggesting office space will make up just 75% of the overall mix by 2028. So I'm pleased to say we have Shobi Khan, the CEO of Canary Wharf Group, joining us now. So welcome, Shobi. Thank you so much for having us here, first of all. And I want to get to retail and all of that in a second. But first, I want to start off with office space, because if you think about back during the height of the pandemic, there was all of these rumours circulating, wasn't there, Steve, about the death of the office. But you fast forward 5 years, what is that picture looking like now? What are you seeing in terms of occupancy rates and return to office here at Canary Wharf?
Well, first, welcome to Canary Wharf. It's great to have you guys, and appreciate you guys making the time to hopefully come. Seeing is believing of what we've done here. I think Canary Wharf is thriving. I mentioned to you guys earlier, this is going to be our best office leasing year in over a decade. We're on track to get over close to 800,000 square feet of office leasing right now. Our vacancy right now is only 6%. And I attribute that to three main reasons. One, the convenience of the Elizabeth line now. People are using it now, they're seeing how convenient it is, and access has never been better than before. Two, you'll see this place. Now it's thriving. We've got an unbelievable blue-green ecosystem. We've got tons of amenities. We've got residential. You mentioned hotels. 4 years ago, we didn't have any hotels. By March of next year, we'll have 4 hotels. And then real estate's about demand and supply, right? And so the construction pipeline is basically turning off after 26. And so rents are being increased. And so we're pushing rents and we're getting the benefit of having, limited space for occupants to look at.
You've had some big wins for Canary Wharf just, in the last few months. We saw HSB returning. They needed more desks for returning workers. There's also speculation that JP Morgan is looking to rebuild here and Deutsche Bank looking to also sign leases here. Is this all down for banks calling for their workers to get back into the office full time? And what are companies saying when they're looking at new spaces here? What are their requirements?
Everyone's definitely back. I think, the demand for office space, like I said, has never been higher. They're looking at the different kinds of spaces they want. They want to make sure their spaces not only have collaboration space, but be able to use technology and all that stuff. But it's not only about the space, but it's also about the place of what they can do when workers are coming into the office. What amenities do they have? What facilities they have? What services they have? And that, in our mind, is we're serving them not only a great space, but the place of Canary Wharf. I mean, we have a community. I think you were a part of Wharf Connects that came here and saw how we brought that community together. Just last month, we had our first 5K, which will be an annual tradition now. And so I think it's also connecting with the community, and that's one of our IPs.
Yeah, it's come a long way, and as you know, I've known this area my entire life as well, and it is just phenomenal, the transformation as well. But I have given you a hard time previously, I know that, about whether, to Richard's point as well, whether you're ever going to see that kind of occupancy that we saw perhaps pre-COVID as well. But it is back, and obviously you're talking about mixed usage as well. You've talked a lot about residential and creating more community down here as well. That said, is the UK government giving you enough support with both real regulatory change and permit changing, because they talk a lot about that, and all taxation, or do you have real concerns that the government is going to thwart some of the best intentions for you and others who are trying to grow this area?
So I'd step back and say, London is one of the world's greatest cities, right? And it's got unbelievable universities. It's got the rule of law, the time zone. It's got lots of incentives for people. And so I think what the government needs to do is have a stable tax policy so that business can know what the predictability of that is, and then incentivize companies to here. Because if you're an individual or a company, London is a fantastic city to be in. And I think they need to set up that policy to incentivize these businesses to be here.
Give me a policy that you don't want to see or you do want to see from the upcoming budget.
Like I mentioned earlier, the residential market where we're long on, we've got our opening up our next residential tower this week, and then we've got another 2, so we're going to be adding thousands of units onto Canary Wharf. But there's no construction pipeline post 26. And I think the government should incentivize developers to build by offering, whether it be, a reduction in affordable housing or some incentive in a short amount of time period to boost that productivity, to bring in more housing, because London has a dearth of supply of housing right now.
Also, just one more for me about the competition with other financial centres as well. Look, we've got another pretty good financial centre up the road. I often do the run between the two, and I love it, and I love seeing the transformation as well. But there's a whole area in between, actually, which between the City of London and between the Wharf as well, which actually could really do with some development as well. Any thoughts about expanding your footprint, or is it very much about the Wharf and the Isle?
No, historically Canary Wharf's developed in the city. We've done obviously the walkie-talkie building. We've got right now development in South Bank where we're doing a mixed use, and it's our last residential for sale product there. So absolutely, when the opportunity is right, we're a developer of high quality mixed use projects.
What I'm really interested in, and Steve just mentioned there, domestically expanding, but how does it compare to New York, the vibrancy of New York, where we do here?
Well, you spent a lot of your career.
I did spend a lot of my time there.
How many years were you there before you came back?
7.5 years, so a big chunk of my career spent there, and I recently returned, so I've been making all the comparisons, and especially these conversations that we have now about particularly when we talk about IPOs and companies delisting from the London Stock Exchange, moving their headquarters to New York. Are you concerned about that? Companies deciding, okay, we're better off there, that's better for our valuations, for getting more funding. How does it compare to New York?
They're different cities. They're both great cities. I think they both benefit from an amazing financial services industry and all that stuff. I think both benefit from this boom in technology. I think both London, New York in general are going to benefit from this AI wave. I mean, Revolut just opened their HQ yesterday, and they've promised to invest $3 billion in the UK economy. We've got lots of different companies now, I think, that are on that wave that I think you're going to see continued growth in.
And who are some of your big investors here in Canary Wharf? Where is that money coming from? And what do you think the government needs to do to attract more FDI into Canary Wharf, particularly as we think about the autumn budget, of course, the Labour Party conference next week, where these discussions are going to be ramped up?
I think it gets back to my earlier point about stable tax policy. I think if you have a stable tax policy, businesses want certainty, and if you have that certainty, then they will invest. Like I said, London's a great city to invest in. We're fortunate that we've got great investors in Brookfield and QIA, long-term investors. They see the benefits of London and the benefits of this economy.
Shobi, I'm going to follow up on that point again because you've mentioned it twice. You are one of the most well-connected people around. I know that you have connections with some serious players down here as well. That's part of the reason why they're not only staying here, but they're growing their operations here. We talked about permitting, we talked about residential rules and regulations so that you can grow the pipeline after 2026 as well. Is that the problem on the talent side? That actually, even though you've got enormous facilities here and a lot of brilliant international talent coming down here, if they don't get the tax policy right, we're just not going to attract the international talent, let alone the UK talent.
I would agree with that comment. that uncertainty of, the recent changes with non-dom inheritance tax, et cetera. There's now potential talks about taxing on wealth. That just creates uncertainty. And people, I would say, like, you fast forward into the residential market. The residential market on the for sale product is kind of, people are on their hands right now. They're like, don't want to make committed decision until they see what's going to happen in November, because they could make a decision that could be reversed and so forth like that.
I'm going to ask you a question, which I would normally ask a CEO off camera and get a certain answer, but I'm going to ask you on camera as well. I'm going to put you on the spot, sorry. Is the government speaking to people like you? Are you speaking to the government and giving them solid advice? Because I'll tell you my experiences. I speak to some amazing grandees and senior businesswomen and businessmen, and I'm always gobsmacked at how little communication the government is having with them. Are you in communication with the government about these things?
Absolutely. I think we've got a
great...
Do you
think they're listening?
I do think so. And I think, we've got some various incentives that we've proposed.
Yeah.
Fingers crossed, we'll see what happens with this budget, but they're listening. And I think the question is, will they implement policies for the growth initiative that everybody wants for London and the UK?
Yeah. Superb. Shobi, honestly, it's been great not only interviewing you, but your hospitality down here has been fantastic as well. So thank you very much indeed for having us. So Shobi Khan, the CEO of Canary Wharf Group. Juliana, it's lovely to see you. I'm glad you're back on set. What have we got coming up?
Steve, it's great to see you and Ritika. Loving the coverage from Canary Wharf this morning. Still ahead on the show, we've got lots going on this morning. JD Sports says it expects a limited impact from U.S. tariffs this financial year and remains cautious on the second half after reporting a dip in H1 profit. We'll discuss more with the CEO next. Plus, the Trump administration puts forward a proposal to rework the H-1B visa system. We'll have more this hour, and we'll bring you more of our interview with the Spanish Foreign Affairs Minister as Trump lays into Europe. That's coming up at 7:40 BST. Welcome back to the program. JD Sport has reported a 13.5% decline in first half profit, although sales for the period came in ahead of expectations. The sportswear retailer said it expected a limited impact from U.S. tariffs in the second half and remains cautious on the trading environment. Regis Schultz joins us now, CEO of JD Group. So great to have you with us this morning. First, let's just hear from you how sales are progressing in the recent trading period across your key regions.
Yeah, I think that it has been a difficult first quarter in US. Second quarter has been getting better, and we're always amazed by the US consumer resilience. So whatever happens, they are buying, and they are buying products, and they are buying sneakers because that's what they like. UK has been more challenging in Q2. Q1 was good. Q2, we had a big events last year with the Euro Cup where England did well. So I think that we had this impact from last year, the Olympic Games. So I think that has been impacting us negatively. And Europe is doing okay. So I think that you can see that it's more on how much innovation we are bringing, what are the sports events, what are driving the demand. But I think we see a consumer which is the world is changing every day, and I think that this perpetual change doesn't give really a clear demand for the consumer. But what we know and what we see is that every time that you bring new product, exciting story to the consumer, they are buying it.
It's amazing how important innovation is in this space, it seems. When I look at your result, I think the weak point that will stand out to investors is around margins and the margin decline that you saw compared to this time last year. How do you explain that?
I think we have been a little bit more promotional online. The market is tough, and online is more discounting. So I think we have react tactically to that. I think that our margin is down mostly because of the mix. As you know, we did 2 major acquisitions, which are lower margins than the rest of the business. So that's the explanation. But I think we feel that we are, our model is sound and good. Our operating cash flow is up 5%. So because we have been investing a lot in the last 2 years, we have a high level of depreciation that is coming through that. So I think when we look at our cash, we are cash generative. We generate more than 500 million cash for the first half, and it's up 5%. So that's where we feel that we are doing a good job.
Let me just get into one of the comments you said, perpetual change from the consumer. I think that's fascinating because yesterday Kingfisher came to the market with its update. It shot the lights out and the market sort of sat back and said, well, is retail as bad as we think it is if everybody's buying all this Kingfisher product? And we're saying the last time we'd been talking about Kingfisher was right back in the COVID days when people were buying outdoor furniture. So as you talk about the perpetual change, I know you were trying to cycle customers into more performance shoes, sports shoes, rather than just athleisure shoes. So what are you seeing in the cycle in terms of what's working for consumers and what they are prioritizing at that point if their finances are truly constrained?
Yeah, I think that if I take change in our industry, we have seen a big boom around retro basketball shoes. That was 5 years ago, and it's become big number one shoes. Now we see, as you say, running coming back. So it's a movement, it's a trend, and things are getting faster and faster. So in the past, you will say trends will last 3 to 4 years. Now it's 3 to 4 months. So it just constant change and constant view around, because you get all information and every trend. Usually what happened in the past, the trend start in London, Paris, and it getting to the rest was taking time. Now it's getting the day after because of social network.
Yeah, thank goodness you can track it digitally. Now Steve wants to play, so just look down the barrel of the camera and he'll jump in with a question for you.
Hi, Steve.
Regis, I'm an addict on this sector as well, and you and I have had some amazing conversations with Karen and Juliana over the years as well. Look, I've noticed something happened with Nike share price, and every time they have another problem as being the behemoth in the sector, I often look at what JD Sport does afterwards as well. Nike have had basically a really tough time on the athleisure arena for a long time. You know this, and how on the retro, Adidas has knocked the ball out of the park, and then you've had new players coming on like On, who are doing such great business at JD and elsewhere. What do you think about the destiny of Nike and the importance of that for the importance of your sector?
Nike as a market leader is really important for the sector because they are the biggest player by far, and they are the ones that create this market with using a sport product in their everyday life. And I think that is important for us. I think they have done a complete reset with a new CEO that are doing a great job. And I think that what they come with in terms of running is really great, and we can see the first element of that. At the same moment, they need to manage really the historical franchise that has been putting them at the top of the market. So I think it's a tough job, but Elliott is doing a great job.
My concern is, and I think it is important, like you do as well, because as you say, they are the market leader, they are the behemoth in the sector. I don't know if they've got the retro lines that Adidas and others have got. I mean, you know better than I do, Regis, and we've both studied it for decades. The extraordinary back catalogue of amazing shoes that Adidas have had. And again, as I say, plus the new players on the block, the Ons of this world, which are really doing incredible business. Can Nike ever get back to where it was? Because it's important not only for them, but I'd imagine also for you in the United States.
Yeah, for us, what is important is that the market is healthy. And I think that, as you said, the market is full of new brands with On, Hoka. And I think that Adidas has done a great job with the Terrace, with all the retros that they have in their catalog. So I think for us, what is the most important is how much newness is in the market, how much innovation. After that, we are multi-brand, and we are very agile to move from one brand to another one. So let's see who is winning, and we will win with a winner.
Let me bounce from the trends to the tariffs, because it is big news stateside still. Even the Federal Reserve is still trying to gauge what the impact is of pricing pressure on a lot of goods. What are you seeing in terms of the move from the inventory stockpiling to the actual hard-hitting ramifications of pricing pressures being passed on to consumers? Will you pass on those prices, and do you think others will too?
Yeah, we have seen in our industry that we have done surgical passing to the consumer. All the things we have done, if the product is good, price is not the issue. So it's as much, the key question for us is the product good enough in order to support an extra 5-10%? That's really the question. And what has been done so far has been to put that on products that everyone believes that they can support, and we have not seen any impact so far.
Just a very quick one to satisfy my curiosity. Automation for JD Europe. You flagged that today for the replenishment of stores. What does that mean in terms of more automation? Is that leading into some of the AI trends?
Yeah, our supply chain in Europe has not been great. We used to have a great supply chain from UK for all Europe. No more possible with Brexit. We have to rebuild a warehouse completely. We have done that. It has taken more time than we were expecting. It's live. It's going to be live Monday with automation. So we are now doing it manually because we had to do it in a hurry because Brexit happened. Now we are moving to a much better solution with automation. We are, this facility that we have in Netherlands is handling 100 million pieces per year. So it's a big beast. And doing that manually, for sure, it's much more costly and much less efficient than doing with automation.
Well, good luck with Beast next week, and thank you for coming to see us.
Thank you.
Regis Schultz with us, the CEO of JD Group. We were just talking about the US Central Bank, and Fed Chair Jerome Powell has described stocks as fairly highly valued, but stressed that this is not a time of elevated financial stability risks. Powell has come under significant pressure from President Trump to lower interest rates, but took aim at those who accused the Fed of being political, saying it is just a cheap shot. The Fed chair also reiterated his belief that there are no risk-free paths left for the central bank, signaling that further rate cuts are not guaranteed.
Near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path. If we ease too aggressively, we could leave the inflation job unfinished and need to reverse course later to fully restore 2% inflation. If we maintain restrictive policy too long, the labor market could soften unnecessarily. When our goals are in tension like this, our framework has long called for us to balance both sides of our dual mandate.
Let's get to the market reaction to those comments from Jay Powell. That was certainly one of the factors driving the trade yesterday. We ultimately saw all three of the major indices end lower. The tech-heavy NASDAQ losing almost 1%, as you heard there, Fed Chair Powell highlighting the two-sided risks to the outlook here. On the one hand, upside risk to inflation. On the other hand, downside risk to the employment picture. And recently, the market has been focused much more on risks to the downside on the employment front. So now inflation coming back into the mix. Also, of course, a lot of AI concern floating around after the NVIDIA OpenAI partnership announced earlier this week, sparking fears around the circular nature of the AI ecosystem. And NVIDIA was the biggest drag on the NASDAQ in yesterday's trade. Now moving on to dollar crosses, here's where the greenback sits this morning. You've got euro dollar weaker to the tune of about 0.2%, sterling down as well by about a similar margin versus the dollar. We're hovering around the 134.95 mark. We've also got a dollar strength this morning versus the Japanese yen and the Swiss franc. So a story of dollar strength this morning. In terms of treasury markets, here's where we sit right now across the curve. You've got the 30-year trading around 4.715%, the 10-year 4.1%, and we are lower across the board. Speaking to CNBC, Chicago Fed President Austin Goolsbee gave his take on where rates currently stand.
If you hold the rate at some level and inflation creeps up, you're passive cutting. So I don't see that the real rate is as restrictive as it was before we started getting this inflation. But I still think in the period before April 2nd, before we started getting some of these shocks, I thought we were on the rate down. As inflation comes down to 2%, we could still go down a fair amount with the rate. What's neutral, I think, is below where we are now.